to the Capital Discussions Roundtable. I'm Tom Nunemaker with our guest, Tim Pierson. Before we get started, a quick disclaimer: the Capital Discussion is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all your risks prior to placing any trades. And hypothetical computer simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. So with that out of the way, and this is for educational purposes only, just a reminder. Welcome, Tim. I think this is the first time you've been on the roundtable. So welcome, and I'm sure people will enjoy what you have to say about Dan Harvey's road trip trade. Dan couldn't make it. He's got a doctor's appointment, unfortunately, but he said he'll watch the recording.
Oh, okay. Very good. Well, basically, Dan came up with this trade, and Tom, you presented it a month ago or something, and there's a lot of excitement about it. So I thought I'd take a look at it as well. But I don't trade any new strategy without doing a lot of back testing and a lot of what ifs and up markets and down markets. And in my back testing, I learned some things about this trade. I've been able to come up with some rules that customize it for me. And that's what I want to show you today. Let's see here. You can see my screen, right?
Sure can.
Okay. So I have about 3 or 4 subjects I want to talk about that might seem disconnected, but they all relate to the road trip trade. And it's just things I found in my back testing and a little analysis I did. And then maybe we can, I'd like to have some discussion. I'd like to know your guys' thoughts on what I came up with here. So let me bring up my spreadsheet that shows the results of my back testing. We'll start with that. Now, I meant to test a full 2 years of this. I haven't yet completed that. You can see all these blank rows in here. These are months that I meant to do, and I still haven't finished it, so I have more work to do. But one of the questions about the road trip trade was, what do you do if you can't meet your entry price? You know, the slides suggested that we get an entry price of not more than $1.25. And I found, at least using OptionView for back testing, there were a bunch of months in a row back in 2014 where, you know, the price was $3.50, $4, and at any rate above $2. And I pretty much said that doesn't meet the guidelines, so I wouldn't even be able to trade it then. But I went forward from there and came up with an idea that I'll show you in a few minutes that might allow these to be tradable anyway in these time frames. And a lot of people have said that this trade might not work very well in a low VIX environment. And so these trades where the entry quote was more than $2, the VIX was between 11 and 15 during this time frame. For purposes of this talk, I'll call that a low VIX environment, and we'll see what we can do with it. One of them I thought was marginal. That was this one here at $1.21, but I traded it anyway. I took a loss on it, and I'm not prepared to walk through that, but this is one of the things that made me realize that this trade is very sensitive to your entry price, extremely sensitive to your entry price. And if you pay at $1.25 versus, let's say, 20 cents debit, that's going to make a huge difference on this trade as you go through it. It could make the difference between a profitable trade and a losing trade. Down into 2015, we had the VIX environment that was somewhere between 15 and 53. It had a spike up to 53, but most of the time it was probably between 15 and 20. And you can see that these trades had a decent open price within the guidelines and generally worked out pretty well, especially here. So I think that I would conclude this trade definitely does work well in a high VIX environment, and it can work well in a low VIX environment. Any questions on my back testing before I go on?
Nothing in the chat yet.
Okay. So, I learned also from this back testing that if this trade goes against me and gets near the bottom of the tent, I learned that I had a lot of trouble using put debit spreads or long puts as per the guidelines to save the trade. I had a lot of trouble with that, so I finally decided I'm just not going to do that. So my plan on this trade is going to be, if we get to the bottom of the tent, I'm going to either exit or roll down, and I'll show you an example of that in a few minutes. Somebody asked the size of these trades. I believe these were all 6-lot trades as presented in the guidelines. I was trying to be standardized on 6-lot. Yes, the sampling size is not as big as I would like. I need to finish this out and see if we can draw more conclusions. Okay, so with the idea that it's very sensitive to the entry price, and a lot of times the entry price is more than $1.25, and so you might say you can't make the trade. I started doing a little analysis on it, and I came up with this spreadsheet and this data. So every example in this spreadsheet was based on an entry January 10, 2004. That was 70 days to expiration. It was a March expiration. VIX on that day was 12.14, a low VIX. And SPX was at 1836.8. Okay? So if you look at just the guidelines, as I interpret them, it says the top long should be within 5 points of the current price. So I started by having the top long be 1840, and then 40 points below that and 50 points below that. Now, just looking at this row, the price was $3.93. Now, I should comment, these are pricing from OptionView. I am not convinced that OptionView is accurate here, not because of its data, but because we have noticed that if you look at this trade in real time that you're going to try to put on a new one, for example, I have seen the price of the butterfly swing from $1.10, $1.30, all the way down to 20 cents within a few minutes for no move in the SPX. So OptionView is may not be showing us accurate data. This may not be valid to say, but at least on this day at that time, OptionView was pricing it at $3.93. I guess I would throw in, when I've entered a few of these trades, if it was quoting at 70 or 80 or 90 cents, I'll put my order in at 20 cents and let it sit for a little while, and sure enough, I've got filled from doing that. So what I'm trying to show here is if you start adjusting the strikes and make this even more of a broken wing butterfly than it was, you can greatly affect the price. So, for example, if I keep the middle and the bottom the same and I bring the top down to 1835, price in OptionView went from $3.93 to $1.63. And if I went down to 1830, it came out at 56 cents credit. Now, this has an effect on your delta and your margin as well, so I recorded all that. For a 6-lot, these are the delta numbers that OptionView showed at those strikes. Initially it was -8, but by the time I went down 10 points on the top, it was +16. Now, this is basically a bullish trade with some downward hedgeability. I don't, as such, I expect that I want the delta to be a bit positive when I open this trade. So I would like this, for me personally, I would choose this +16, and I would say that's very acceptable delta for the trade. What I call the upper wing at expiration, on a butterfly, the upper wing is the flat part up to infinity on the top side. This is the P&L at expiration on the upper wing. And if you actually paid $393 for this trade times 6, that amounts to $2,358. That upper wing is going to be below zero, and I have found in my back testing that it would be impossible to make this trade work with it that low below zero when you open it. I think that's probably Dan Harvey saw that as well, and that's why he came up with his suggestion of $1.25 for the entry price. But moving the top long down changes it quite a bit from 23.58 to minus 9.78 to positive 3.42, which is 56 cents credit. Now, yes, it does raise the margin. For me, based on this backtest and this analysis, I am deciding that margin for a 6 lot, for me, the way I want to trade it, is going to be in the $8,000 to $10,000 or $12,000 range. I'm not trying to keep it within $6,000 or $8,500 as we had in the slides. I think it's more beneficial to lower these top strikes and get a better entry price and have a little more margin than it is to try to control the margin strictly to 6,500. Now over here, what I'm trying to show is for every 5 points down, how much did the price change? And same for the margin, how much did it change? And same for the delta, how much did it change? Because I wanted to compare the effect of lowering the bottom long and leaving the top one alone versus lowering the top long and leaving the bottom one alone. So that's what this second set of data is. I was able to get the price to be accredited, just like on the top, but my margin went from 11 to 16,000 for doing that. Up here it only went up by about 4,000, so I feel that's one reason why lowering the bottom long isn't probably the best approach here if you're going to make this a broken wing. I was able to get the upper wing reasonable, but not as good as I did up here. So for all those reasons, and for the reason that this shows the price change for every 5 points to lower the bottom isn't as great as it is for every 5 points to lower the top. The margin change was greater on the bottom, which is reflected here between 11 and 16,000. That's another reason why. Now the delta change was not as pronounced as lowering the top, and actually would have liked that. So I guess there's a trade-off here, but we had a delta effect of about 12 points per 5 points change to the upper long. But down for the moving the lower long, it's about half as much. Now, accepting a delta of 10 to 20 is what I've told myself I'm going to take. I'm okay with this much of a change for lowering the 5 points. Let's see some questions. Can the market go up so far and fast the trade will lose? Yes, but I'll show you something about that when I get to my next point. Sampling size looks small. Entry is close to 70. For this analysis, I believe I used 70 days, and for my back testing, I used 60 to 70 days, whatever it took to find a down day. But for this example, and for an example I'm going to show you in a few minutes, I actually used an entry on an up day because I was trying to do everything wrong in my testing. A down day with a certain move percentage, I'm not sure. I did a lot of these parking trades, and we want a down day for that. I ended up concluding with those that if you have a down day of 10 or 15 points on SPX, it's probably good enough and you can do it. Unless it's really falling fast, then you should watch and see how far it'll go. So I guess right now I'm not looking for a certain down percentage. I'd just be looking for a bit of a down day to help get lower strikes. Typo. Okay. Does this entry? Yes, it does. I'm going to show you on another screen. I believe that if you get a credit or a very small debit, you do have higher probability of profit and higher probability of higher profit and higher probability of profit, both. Are the prices midpoint at the close? These are prices at 11 a.m. in option views backtest. And I picked that because 11 a.m. is typically about when I would probably open one of these trades. Why is G10 positive, but the others are negative? Okay. Because these are 6-lot tests, column G is simply 6 times the price per butterfly. So 6 times 56, 600 is 336. That's why I put CR in there. This is a credit. These are actually debits, so 6 times negative 393 is negative 2358. Okay, so I know this is like being in college where they don't care about how pretty your data looks. They just show lots of obscure data and expect you to understand it. I'm sorry I didn't do better slides, but this was kind of a quick analysis I was trying to do. So I wondered if, based on everything I see here, maybe a sweet spot is lower the top by 5 points and lower the bottom by 5 points. Doing that gets a credit of 90 cents, which might be a little overkill. But, and the delta is a little higher, but it might actually be a sweet spot for the trade. And that might be one idea to keep in mind if you're having to adjust these strikes when you're opening this trade. I think I didn't go forward and backtest these, but I would probably do this one or this one, either one, and I bet you they would work just fine. Okay, so that's about all I have to show on this spreadsheet. Let me go on then. The next thing I want to show is an actual trade rolling down. Being an M3 trader, we roll down butterflies all the time, and I wondered why don't we just roll these down. So I came up, I took a trade that I actually did for real, and I put an option view, and I can show you what happened. So this is February 2nd at 7:30 a.m. That's Pacific time, so that's an hour after the market opens. I opened this butterfly with the top longs at 1920. That was 7 points above the market. I did not do I did not adjust the strikes on this one because I actually got a credit for it. I got something like 10 cents credit for it. And then 40 points down and 50 points down from there. So it's a standard road trip trade. This is what the trade looked like when I opened it. Let me make that a little bigger. Interesting to note that similar to a lot of these M3s that we trade, this is the area where M3 starts and has a pretty flat line going to the upside. So there's some similarities in that respect. And you can see that the delta was slightly positive. Theta, it is what it was, and note that this is a negative Vega trade, which means that the trade would benefit from a drop in volatility, and I'm not sure what VIX was on February 2nd, but you know it's been pretty high lately, so this trade has a real high chance of profitability based on that. Now I'm going to go to February 9th, just before I rolled it down. And show you what it looked like. Now, I said before, I've kind of decided that I'm not going to work on this trade with put debit spreads or long puts. So my plan is to roll it down or exit when it gets to the bottom of the tent. Option view is being very slow here. There it goes. Okay. So on this day, SPX was 1847. That's down 66 points from where we opened it. And you can see I have a negative P&L. And you can see that we're nearing the bottom of the tent. Now, this is one problem with my plan to exit at the bottom of the tent. Depending on how fast getting to the bottom of the tent happened, in other words, was it early in the trade or late in the trade? In this example, it was early in the trade, your P&L is going to be worse. Later in the trade, you might even be profitable, and I actually had that happen on another one that reached the bottom of the tent. It was slightly profitable, and I just closed it. So, partly because the P&L was fairly negative, and partly because it was early in the trade, and partly because profit target is actually larger than that. I had not reached what I've decided to be max loss, which would be somewhere around 10 or 15%. You can see I had 6,000 margin here. We're nearing 15% right there, but for all those reasons, I decided that I was going to roll this down. We go forward to noon after I did the roll. And now it looks like, whoops, doesn't look like that. That's not right. What happened here? I lost my long. You know, I was working fine just before I got on here. I think I'm going to have to...
Oh, looks, maybe it's the 5-point strike is missing.
Oh, I don't have it showing 5-point strikes. Yeah, thanks, Tom. Let's see, let's do that. Now I think we've got it. Okay. Yes. So after the roll, we've got back to basically looking like it would if you did a new entry. And in fact, I simply picked the strikes as I would if I did a new entry. So now I'm hedged, although with some more drawdown, but I'm technically hedged down about 1796. Because of the P&L, I probably would not let it go that far before I would say I've lost and get out. I'd probably do it about here somewhere. I'd probably give up on the trade about here. But if I now go to today, and we make option view work for us, you know, that was near a bottom. SPX has come back up quite a bit, and this trade has turned profitable, and at this point, I'm going to just let it ride out. Now, what's wrong? Should be showing my P&L there. Why isn't it showing me my P&L?
It looks like there's some price data missing.
Yep. Okay, let's try, let's see if we can. How about if I go into BackTrader just a few minutes ago? See if that brings it in. There we go. So this trade has turned profitable. It's in a very nice position, and we can let it go. Now, to get back to, so any questions on this roll and my plan to roll? Looks like there's been a few. Okay, let's see. Yes, accurate prices and option view limits the validity of backtesting results. I question that. Think back isn't any better, so I think it's the best tool we have. Am I advocating have my upper long slightly in the money in lower VIX environments? Yes, and that's what I showed on that last spreadsheet. By doing that, you can bring this top expiration line to 0 or even above 0. And in this case, you can see it's at $540. I have structured that in the roll and when I picked my strikes so that this expiration line is at a decent profit. I don't want it, especially since I've rolled, I don't want that to be below zero. I want to have a good chance of profit without doing anything else. Now I'll show you something else about that when I switch over to Thinkorswim. But essentially what I'm doing when I choose a lower top strike, essentially what I'm doing is the reverse Harvey right up front when you open the trade. Now, I'm going to show you something about that too. So let me go on and get through the questions. How do I define option settings in option view? We'll save that one for a minute. Do I roll up the butterfly when the market moves up? No, and that's what I want to show you. So let me switch over to just showing you that right now. Thinkorswim. Let me go to something that makes sense. When you look at there's another trade. Okay. I'm going to load in one of my live trades. I think it's this one would be good. Oh, okay. So here we are, 50 points above the top of the tent. Now, one of the cool things that I've noticed about the road trip trade is day by day, this T plus zero line goes up way past the top of the tent. Okay, so first thing, I've already got my reverse Harvey done when I open the trade. I've already got an acceptable profit at expiration. But even clear until 10 or 15 days to expiration, the T plus zero line is continuing to rise. As long as I have positive theta, it will continue to rise. And you can see as of March 5th, the day March 5th, which is probably about 3 weeks before expiration, I still have positive theta, and it's way above the expiration P&L. I'm going to go forward day by day here, and as I do that, let's watch the theta. Theta continues to increase, but at some point it's going to stop increasing. Right there. See, oh, I'm sorry, nope, I read that wrong. There. It was 51.65 a couple of days ago. Now it's starting to decline. So that's the shift in the rate of change of the T plus zero line. Now it's still increasing because I have positive theta, and my P&L is so wonderful that I would probably exit the trade here. But one of the things that I'm going to say when I do this trade is watch that theta turning point and set up your red flags that you might have to exit pretty soon. Because sometimes as you keep going forward, it drops very fast. This one's not dropping quite so fast, but I've seen others go from like 50 to 10 in one day. And that's when you're not making any more money, so you might as well get out. So if it ever turns negative, I'll be out for sure on that day. So we've got a T plus zero line up 80, 100 points or so, where you're still making money, even higher than the expiration graph up until a week or two before expiration. And I think that's probably why Dan said typically exit from 10 to 14 days. Does that make sense?
It does, and Dan said, frequently it'll pull back a little bit too, and your negative delta at that point.
Yes. Yes. That is why I don't roll the butterfly up. If I've done my reverse Harvey up front by changing the strikes when I rolled or opened the trade so that I've got a decent profit that's acceptable on this upper expiration line, I will never roll it up again. And I will never do a reverse Harvey again. I don't have to. I'm happy with the trade. $660 is somewhere around 10%. That's not bad. Can't argue with that. DOS, I am not using the volatility smile setting. I avoid trying to use that. I find it confusing, but it is the best approximation that gets as close to option view as TOS can get. But I don't typically use that. Okay. Let me look at my notes here, because I have another thing or two I want to point out. I did actually backtrust a trade that I called low VIX, and I want to show you that trade. So let me go back to option view.
So Tim, maybe before you start that, John Bailey had a question for you.
Oh. Yeah, I'm operating slow today, you guys. Bear with me. Narrowed the wing, independent of where you can place. Yes, that is what I'm suggesting. In a low vol environment or a low VIX, lowering the top strike is how you can get this positive wing. It's how you can get a credit or a very good price on entry, and it doesn't increase the margin or the delta by too much. It's still all acceptable. Teenies, I have not tested this with teenies. It's also something else I don't want to do if I'm going to do this trade. I just don't do insurance. I know that the slides that Tom presented and Dan did show the use of teenies, and I think it can work. It's just another way to trade this trade, but I don't do teenies. Okay, let me go into my low VIX example. We're going to go back in time. March 7th, 2014, 11 a.m. And I have to switch to the right account here as soon as it's done. Come on. Sometimes it's fast, sometimes it's not. Okay. Low VIX. Okay. So on this day, VIX was 14.11. That's kind of low. It's not as low as it's been, but I think it was a good example here. I will go back and backtest this some more with VIX as low as 11 or so on open, and we'll see how it works with that. But this is the example that I worked up. So let's see if I can make this show the whole thing. Yeah. All right, SPX is at 1875. You can see that I picked some lower strikes and I split them. I feel that if you don't have to get as aggressive to put all 6 of them 10 points lower, you can be less aggressive and put half of them 5 points and half of them 10 points lower, which is what I did here for the opening of this trade. And then from there, it should be a standard road trip, 40 points and 50 points. Now, here's my trademark, you might say. The expiration line is just barely below 0 when I open the trade. And that's what I'm looking for. And that's how I chose how far to split the top strikes. Other than that, it's a standard road trip trade. Let me get this other line out of here so I can see kind of how it looked. All right, so I also made a note that this day, March 7th, 2014, was an up day, so I'm trying to have this be, as wrong as I can get it. It was down here, but I believe by the end of the day it was up. This trade took 10,000 in margin, and the way we look at that is in option view. You look at the bottom one here, and it says it's 10,000 in margin. And I got 12 cents credit for putting it on. At least that's what I wrote down. And delta was slightly positive. Yeah, 6. Okay, and Marilyn has a question. The reason to split the top strikes because of delta? No. I'm splitting the top strikes so that I can get this expiration graph to the upside above zero, or, you know, within $50 of zero is kind of what I'm thinking. In this case, I got just slightly above zero. If we simulate not having done what I did, I think we can do that. I'll just put a trade on. Now you can see the expiration line is negative $555, and that relates to my entry price, by the way. I would not do this trade for the top being that low. I would want to adjust the strikes so that I get much more closer to zero. I hope, Marilyn, does that answer your question? Okay. Now, I'm going to go forward to March 28th at 11 a.m. We were at 1875 when we opened this trade. On March 28th, we were down 17 points from where we opened it, which you'll see in a minute. But it's being slow today. It's been very slow today. Here we go. 1858, it had been lower, but at 11 a.m. it was up 9 points from its low. I just picked 11 a.m. to be consistent. I have not done anything to the trade. If you look at it, it's in a sweet spot. It's perfect. There's nothing to do on this trade, and we've got positive P&L. But I wanted to point out, if you did want to do a reverse Harvey and move these top three down to here, you could, and you get $2.05 credit for doing that. And on the graph, that raises this line, just like Dan and Tom showed, it raises the line quite a bit when you do it. But my point is, the lower the SPX is when you do your reverse Harvey, the more advantageous it is, because it's really just a credit spread, and the lower SPX is, the higher the credit you get for a credit spread. Now, we're going to go forward, and I'll show you another example of that. I'm not sure, Robert, what you say. Bandwidth is being used. Are you able to see it?
Commenting that option view is slow because you're using bandwidth for the presentation.
Got it. And I have two other Thinkorswim computers up running, and yeah, I have a lot of stuff running. Okay. So that's my entire point. The lower SPX is when you do your reverse Harvey, the more advantageous it is to do it, and the more it'll help you. Let me take this out because I didn't actually do anything to this trade. And now let's go forward to April 11th, which is the low in the trade. See how long it takes this time. SPX was at 1822. And VIX had spiked up to 17.03. So that's a good point. We started with VIX at 14. It's now up to 17. It has risen, which should be against us in this trade because it's a negative Vega trade. But we have positive P&L, and I would basically say there's nothing to do, nothing to worry about yet at this point. Down here somewhere is where I might roll it or close it or do something, but especially with a positive P&L at this point, I'm not going to do anything. However, if you now did a reverse Harvey, I just want to point this out, you get about $3.25 credit for it. That's 50% more than we got when it was up at 1858. And if you look at the graph now, now my upside P&L is 981, and on a margin of 11K, that's about 8 or 9%. I'll never have to do anything to this trade if the market goes up. It'll be truly no touch from here on out. Now I'm going to go forward to April 21st. The market has recovered a little bit. Oops, 21, okay. And VIX is back down to 13.25. The market is at 1870. And our P&L is 1900 on margin of 11, so it's well over 10%, and it's probably more like 14 or 15% if I did the math. This would be a candidate exit for me anyway. I'd rather take it all off the table and just get out. Now it's 25 days to go. You can stay out or you can stay in. It's certainly not late in the trade, and being above the graph is certainly a very safe position. So let me go forward to the 28th when SPX was at 1854. It was down from here, down 16 points. But you'll see that the position has continued to improve, and this is one of the beautiful things about Road Trip. It's amazing how much the T+0 continues to rise, being far out of the tent to the upside. That's one of the really nice things about this trade. And I would add, it works that way in M3s and butterflies and other trades as well. So if, for example, you build a structure where you have, let me just go to the graph. If you build a structure where you have a bulge in the tent here and then some stuff and another bulge in the tent here, kind of like you had double butterflies, some on the top and some in the middle with a lull in the middle. Well, day by day, these two peaks of the tent will pull up the T+0 higher than you think it would go in the middle. I think that's a very key thing to remember when you're doing M3s or any other form of butterfly, Kevlar, Rhino, anything like that. It's one of the ways you can improve the trade and widen the tent both at the same time by putting another tent way up here and have some gap in between, as opposed to putting the second tent right here and having them overlap, which is what we think we might have to do because the graph looks good. But you should always remember you can pull up the middle of the tent by having one up here.
Hey, Tim, I think you're still including that reverse Harvey that you showed in this analyzed part.
Let me take it out. Yeah, I never converted it, so let me just take it out. Yeah, good point. Okay, we're up $2,300 here. SPX has come down a little bit from a week ago, and look at this T+0. Almost 100 points above, just like before. It's still going up. That's a huge hedge in my mind. So 2,300 on a margin of about 11,000. That's, what is that? 20%. I'd certainly be taking this trade off here. But if we stayed in, I'll go to May 5th. Oops, May 5th. And you'll see. Now, SPX has recovered a little bit to 1882, which puts us outside of the tent. Our P&L is about what it was a week ago, but we're outside of the tent. And we have wonderful theta, but notice that it's starting to get small. Theta is all the way down to 9. I would not be staying in this trade anymore at all. At this point, I'd be taking my profit and going on. Okay. That was my low VIX example. Are there any questions on that?
A couple.
How often did I need to make an adjustment? Well, it's an experiment still in progress. I have more back testing to do. I do have a couple of these live. I have rolled down 2 of them in the decline that we had recently, and they've recovered all their loss, and they're all in great shape and they're profitable. And I'm above the top of the tent now, and I'm just letting them sit. Those are April and April 4 trades, if I remember right. So there's still a lot of time. Would I use this trade using SPY instead of SPX? I think that for learning, my opinion is you definitely could. Commissions are going to be 10 times more on a percentage of your profit level or something like that than they will be using SPX. But, you know, your margin would be $600, $800, $1,000 for a 6 lot. And that would be a very good way to start out, yes. And I haven't back tested using SPY. SPY may behave a little bit differently. You need to do your back testing to make sure that the T+0 behaves as I've noticed here in the SPX. I would not do it for real before I had done that so that I know it behaves the same way. Okay. Oh, HNH. Okay. I used 11 AM prices. Well, essentially these are the midpoint. What Option View does is, oops, not that one. Option View is interesting about how it does mids. You can choose to calculate what it shows as the market price of your options, any of these 4 ways. Now, I thought that I had it to here because when you're using backtest data, if you want to get the best mid, Option View's backtest data works best with it set to this. However, I have noticed if you are getting quotes from Thinkorswim using Option View like I do for real-time quotes, guess what? This method does not produce the midpoint. I've done some comparisons. I'll see like 1080 here on an option, and I'll go look at it in Thinkorswim, and I'll look at the mark or the midpoint, and it'll be 1125. And I tore my hair out for a while trying to find out why there'd be such a big difference. I finally found out that if you're using toss quotes and you want to get the actual midpoint, you need to check this one here, bid plus S divided by 2, which is what toss does. So, does that answer your question? Okay. I don't have anything else prepared here. I guess this is a collection of notes and observations about the road trip. I think the way that Tom and Dan presented it, you could trade it that way and be as successful or more. But this is the things I've shown you here is how and why I have made this trade my own and plan to trade it a little bit differently than the slides are.
Well, thanks, Tim. Yeah, I like the road trip, and then it's a typical Dan Harvey with lots of trader's choice type of trade. So,
Yes.
you know, 20 people can get the road trip rules, and 20 people trade 20 different ways.
Yes. And honestly, I didn't expect to be coming up with these tweaks to the trade when I set out to backtest. I simply wanted to backtest and know that it works like I think it was going to work. And then I started seeing the pricing and the delta and the margin and all that stuff, and I thought, well, we can tweak this trade and have a higher chance, for me, of success. I've also
your slippage is set to small. Is that something you use in your back testing?
No, I mean to have that set to none. So my mistake on that. I don't know. I think it probably was set to none. I run Option View on 4 different computers, and they all have different settings, and I need to sit down and figure it out. Get them all set the same.
Yeah, I save mine in a Dropbox folder, so it doesn't matter which computer I open it on. It's all the same.
Yeah, and you know what? I tried that, but I wanted it to be I wanted it to run from the C drive, but I have all my account data in Dropbox, so all the accounts come across, but the settings don't come across, so it's just how I set it up.
Gotcha.
Okay. I was going to comment on Victor's comment here. How would this behave in a high vol environment like we have now? I think very well. I've done 4 of these in this high VIX environment. I did some back testing in high VIX environment. Number one, you get a credit or a very small debit without having to tweak the top long strike price. So you don't have to take a higher margin. You don't have to take a higher delta. You can do it pretty much as presented. It's so wide that, the window of adjustment doesn't close on you fast, like it does if you're doing weeklies. So we can have a 40-point day, and you're not out of the water. You still have choices and options and tools that you can do to manage the trade. And, of course, if the move is to the upside, even 200 points, trade's going to work out, and you're going to be a happy guy. So I think it works very well in a high vol environment, and I think it can work well in a low vol environment, but I need to do more testing.
All right, Tim, really appreciate your sharing all your research. It's nice to see that level of detail applied to Dan's trade.
Yes. Well, thanks for having me on. It was fun. I'll go forward and someday finish my back testing. Maybe I'll have some more rules or ideas,
Great. All right, thanks everyone for joining us, and we'll get this posted in the library as soon as possible if you want to review it. And with that, have a good week trading, and we'll see you all next week.
Okay, bye.